Hi, I'm David Stein on Money for the Rest of Us. And in this video, I answer the questions, should you invest all of your money in the stock market? And if so, how much do you actually need to get started investing in stocks? First, how much do you need to get started investing? The major investing platforms or brokerage firms, they don't have an account minimum. Vanguard, Fidelity, TD Ameritrade, Robinhood, there's no minimum. You can just open an account. And so how much you need to actually get started investing, you just need enough money to buy one share in an exchange traded fund. Because those apps or brokerages allows you to buy ETFs, some ETFs, commission free. So it doesn't cost you anything to actually buy an ETF or some ETFs. For example, the Vanguard Total World Stock Market ETF, VT. On Vanguard's platform, you don't pay a commission to buy that particular ETF. Now that ETF invests in the global stock market. So it has US stocks, non-US stocks, developed markets, emerging markets. One share is $70. So you can buy one share for $70 and be invested in a very diversified way in the stock market. You could buy the iShares All Country World Index ETF. The ticker is ACWI, ACWI. In that case, it sells for about $70 per share. You just need one share and you're invested in the stock market. Now, how much should you invest? Should you put all your money in stocks? Well, if you're just buying one share, that's perfectly fine. It becomes an issue as your account balance begins to grow. Do we have $10,000, $100,000, $1 million? Should it all be invested in the stock market? Well, it depends. It depends on the personal harm. If stocks fell 60%, how would that impact you? Would you panic and sell at the bottom? Would it disrupt your retirement if you're already retired and you lost half your money, 60% of your money? If so, then it's helpful to have investments in other asset types, not just stocks. But stocks are the highest performing asset class historically. And it comes down to what drives the return of the stock market. It's driven by three things: income, the dividends, the share of profits that companies pay to their shareholders. That's the first driver. The second is how quickly are those dividends growing? And those dividends grow as earnings grow. So earnings growth, dividend growth, that impacts the return of the stock market over time. The third element is what are investors willing to pay for those cash flows, for that dividend? That's represented by what's known as the price to earnings ratio. What are investors paying for $1 worth of earnings? Because those earnings, again, drive the dividends. Price to earnings ratio, we call that PE for short. Those are the three drivers. So if you look at the 1950s, in January 1st, 1950, the dividend yield on US stocks as measured by the S&P 500 was 6%. That's really, really high. Right now we have a dividend yield around 2%. Higher dividend yield means higher return for stocks. The price to earnings ratio for stocks on January 1st, 1950 was 7. Right now, the PE for US stocks is over 20. Now, when you look at that, if you have a starting dividend yield of 6% and a very, very low price to earnings ratio, you can expect stocks to do better. And they did. They returned 19% annualized during the 1950s. Now we're in a period where you have much lower dividend yields and higher stock prices, which means stocks are not likely to return 19% annualized. In order to do that, they'd have to have earnings grow extremely fast, or investors 10 years from now would have to want to pay $30 or $40 or $50 in terms of PE, what they're willing to pay for a dollar worth of earnings. So there's no guarantee that the stock market will outperform the bond market or other asset classes. We have to look at what the dividend yield is and some of those other drivers. There's a paper by Edward F. McQuarrie. It's called Stock Market Charts You Never Seen. And it's interesting because usually we look at long-term stock market charts and they might start in 1950, 1926. Well, he goes back into the 19th century. And here are some of the things he found out. Bonds outperform stocks. Bonds are debt instruments, so they just pay interest. They don't have earnings growth, and so typically they will not do as well as stocks. But from 1865 to 1901, that's 36-year period, bonds outperform stocks. Bonds outperform stocks again from 1929 to 1951. That's a 22-year period. Stocks and bonds performed about the same from 1980 to February 2009. That is a 29-year period. So there's no guarantee there. If you invested in the Japanese stock market, Japanese stocks since 1994 have returned only 1% annualized. That's much lower than the US bond market. And if you had bought Japanese stocks in 1994, near the top of their market, you never would have recovered your losses. And that's important to recognize. J.L. Collins writes in his book, The Simple Path to Wealth, that the question is, if you're going to invest in the stock market, you have to be willing to lose 60% of your money at some point. That's hard, because what if it took 5 years to recover those losses? 10 years, 15 years, 20 years. And so we have to scale our stock exposure to the personal harm that such losses would have on us. And as you near retirement, that harm grows. And that's why typically you want to have less money in stocks and more in, let's say, real estate or bonds or other asset types. So should you put 100% of your investments in stocks? Well, you can, as long as you're comfortable that you can lose more than half your money, and you're patient and you're willing to ride those losses out. If you're not willing to do so, well, then you don't put all your money in stocks. You put it in other asset types that have different return drivers, and you become more diversified. Should you invest in stocks? Absolutely. Should you put all your money in the stock market? It depends. When you're younger, you can put more in stocks. Hey, if you have any questions on this video or any comments, please post those below. And go ahead and subscribe to my channel. You'll be notified each time I post a video. Thanks.